Hello everyone, welcome to Centricity Speaks. My name is Sachin Jasuja and in today's episode, we welcome Aditya Shankar to discuss some interesting fixed income options. But before that, let me thank you for your great response in the last video where Aditya discussed about 4 fixed income ideas which beat FD returns. So in this video, let's explore some more fixed income ideas. So let's get started.
Hello to our viewers, and again, let me just take this opportunity to thank our viewers for the thunderous response that we got. I received many personal messages also giving me a lot of feedback, so thank you for that. Sachin, so as you might know, fixed income is a very vast discipline, and it would take us multiple episodes to cover the entire spectrum available. So, as a continuation of the last episode, we'll explore 4 other options which are very popular with investors and which might interest other investors who have not yet sampled these investments in their portfolio. The first such option is a very basic alternative to a bank fixed deposit, which is a corporate fixed deposit or a company fixed deposit.
Okay.
So how is it different from a bank FD? RBI, the apex regulator for banking, RBI permits certain very selective NBFCs and certain very selective corporates to also accept deposits and offer a fixed rate of return.
So Aditya, can any corporate can come up with these FDs?
No, Sachin, this is a very good question. So, all corporates and NBFCs are not permitted to do it. So, RBI is very selective in allowing corporates basis their impeccable balance sheets or a thorough study of their balance sheets, of course,
Okay.
their sustainability and their proven track record.
So what are the options? What are the corporates which generally issue these fixed income instruments?
Yeah,
Fixed.
so I can name certain very popular corporates whose fixed deposits are popular with investors. So these are LIC Housing Finance. In the private sector sphere, there is Bajaj Finance.
Alright.
There is Mahindra Finance. There is even HDFC, which is vastly popular. The ones that I've named are all AAA rated and offer a fixed, fixed rate of returns which are slightly higher than bank fixed deposits. So this
Okay.
is the reason why this is a motivation to opt for a corporate fixed deposit as compared to a bank fixed deposits.
Okay.
As far as the security of these deposits are concerned, one should look at first and foremost the credit rating. So the ones that I've just named are all AAA credit rated. There are also certain other corporates which are slightly lower rated and they offer higher rates of return. One can do a thorough due diligence of these corporates before investing into it, and of course. An advisor or a distributor who has studied these fixed deposit in detail can obviously guide an investor to make the right choice.
Okay, this was about corporate fixed deposits. Now what is the next option which you want to discuss?
So Sachin, the second option that I would want to discuss is an instrument which is relatively new. So in December 2019, the government of India initiated the Bharat Bond ETFs as a means to cater to the borrowing requirement of central public sector enterprises, which are CPSEs as they are called. The mandate for the fundraise under the Bharat Bond ETF program was given to Edelweiss AMC, which essentially managed the whole ETF issue. ETFs, as you know, or exchange traded funds, are essentially just like mutual funds, except that they are passively managed funds, not actively managed funds as most mutual funds are, and the underlying instruments can be both bonds as well as equities. Right? But the Bharat Bond ETF that we're just discussing is a purely fixed income instrument.
All right.
What is the Bharat Bond ETF? Bharat Bond ETF is of course an ETF which has an underlying of not more than 6 to 7 public sector enterprise bonds.
Okay.
Right?
So these are PSU companies.
Yes, PSU companies of whose bonds are being subscribed in these ETFs.
So what are the main holdings of this ETF?
Okay, so the ETF, the Bharat Bond ETF series was issued in 5 series or 5 tranches, maturing in 2023, 2025, 2030, 31, and 32. But if you ask me, the top 6 holdings across these 5 tranches have been NABARD, REC, Power Grid Corporation, National Highway Authority, which is NHAI, Indian Railways Finance Corporation, which is IRFC, and REC, which is the Electricity Corporation.
Okay.
So these have been the top 6 holdings. So like I said, the Bharat Bond ETFs are passively managed, which means that the maturity of the underlying bonds coincide with the maturity of these ETFs itself.
Okay.
So in say if the 2023 tranche matures in a particular month, the underlying bonds will also mature in the same month. So the majority of both will coincide. So in this sense, it is closed-ended in nature. But these ETFs, just like any other ETFs, also offer liquidity. So they are traded daily on the stock exchanges, just like any other stock. So one
Okay.
can, if one wants, one can buy and sell these securities of the stock market, just like any other stock.
So Aditya, in summary, so what are the 3-4 main advantages to go for these kind of ETFs?
So the first main advantage, because we are discussing in alternatives to fixed deposits, the first main criteria would be safety.
Okay.
So the underlying investments in Bharat Bond ETFs are all AAA rated.
Yes,
So
right.
security is the immaculate security of the portfolio is the first main advantage. So all of these are AAA rated, and these are backed by the central government. So there is very low credit risk with the underlying portfolio. Second is that the maturity of the underlying instruments matches the maturity of the ETF itself.
Okay.
So there can be no extension or any other risk associated. So
Okay.
the third main advantage is that they are the lowest cost way of investing into these bonds. So the cost associated with the Bharat Bond ETF is essentially 0.005%.
Okay.
Which is the lowest ever in the history of Indian asset management.
All right. Great.
So as compared to say an actively managed debt mutual fund, which can levy as much as say from anywhere between 0.5% to 1% also.
Okay.
So the low cost associated is a very major pull.
Fine.
Fourth is that these can be bought and sold, or like I mentioned, bought and sold of the stock market like any other stock.
So whether it is on NSE or BSE, so it can be traded. And
yes, they can be traded frequently.
Okay. Fine.
Although, and of course, if we bring the taxation aspect, these are taxed like any other fixed income mutual fund, and one can avail of in the indexation benefits if one is invested in these funds for 3 years or more. But the advisable tenure of investing into these funds is till maturity. So
Okay.
these are essentially hold to maturity investments, and that is how one should essentially invest.
Okay. So what are other options apart from corporate FDs and ETFs, Bharat Bond ETF?
Yeah. So the third option, the investment platform that I would want to discuss is something which has been the oldest way of investing into fixed income in India at least, which is plain vanilla debt mutual funds.
Okay. Fine.
Which is a very wide topic to discuss, and I think we'll need a dedicated episode just to cover the entire spectrum of mutual funds. But
Of
I'll
course.
just touch upon the basic points. So fixed income mutual funds, as the name suggests, invest into fixed income securities. But there is an entire spectrum of fixed income mutual funds that one has to explore. So on the lower end of the spectrum in terms of risk and return expectation, we have money market mutual funds or liquid mutual funds, which act as a parking instrument.
Yes.
And on the highest risk spectrum, there are credit mutual funds, credit debt mutual funds, which
Okay.
invest into credit opportunities. These offer the highest return, but also come with commensurate risk. So what I would want to discuss here is two main parameters, that one would want to consider before choosing a fixed income mutual fund, depending on one's risk appetite and return expectation. The first is, of course, YTM, which is yield to maturity,
Okay.
which is essentially a window into what is the expected return over a certain time period, which is the investment horizon of the investor.
Okay.
Which is a YTM of a fund is essentially like a average of the or a summation of the YTM of the underlying debt instruments.
Okay.
So every debt instrument has a YTM, and the more or less the combined YTM of the portfolio is the fund's YTM. As far as the definition goes, if one was to hold the entire portfolio till maturity, what would be the expected return? That is the YTM of the mutual fund. The second most important factor while considering a mutual fund, a debt mutual fund, is the modified duration. So modified duration is a fairly complicated concept, but in layman's term, it essentially studies the sensitivity of the return in response to the changing interest rates. So there is a negative correlation in the sense that if interest rates in the economy go up, there will be a negative impact on the return of the fund, and vice versa. But the modified duration, or the higher the modified duration, the higher is that sensitivity, and lower the modified duration, lower is the sensitivity. So one has to be cognizant of this concept while investing into
Yes.
a debt mutual fund. Just to give you a very brief example, and this I derive from my experience in my career, which is that just because the credit rating of the underlying portfolio is impeccable does not mean that the debt mutual fund does not carry any risk. For
Okay.
example, one can invest into something called a GSEC fund or a government securities fund,
Mhm.
where the underlying is government securities, which, as you know, are the highest credit rated securities in India, which is sovereign rating.
Yes.
But the modified duration of these instruments of these mutual funds are very high, which means that the
Yes.
sensitivity to changes in interest rates is very high.
Okay, great.
And if there is an adverse movement in the interest rates in the economy, then one might end up even making a loss in these mutual funds. Just to kind of broadly cover the spectrum, there are at the left hand side of the spectrum, starting with lowest risk and lowest return, is something called liquid mutual fund or a money market mutual fund. Somewhere in the middle, for medium to long term deployments, is a banking and debt PSU debt fund. There are corporate debt funds. There are dynamic debt funds, dynamic bond funds. And on the higher side of the spectrum, where we would expect the highest YTMs and the highest risk associated, we can look at credit debt funds and possibly even GSEC debt funds, which like I just mentioned, although the credit rating is very high, the modified duration is very high, so the risk associated is also very high.
Okay.
So just like I always say, there has to be a match between the return expectations and the risk appetite of the investor while choosing something as basic as a debt mutual fund also.
Okay, fine.
Yeah.
Great.
So and also we'll cover these instruments in much more detail in an upcoming episode.
Of course.
Sachin, the final instrument that I would want to discuss in this episode, where we're discussing alternatives for fixed deposits, is something called as a perpetual bond, or perps as they are
Yes.
popularly called. So perpetual bonds are, as the name suggests, are bonds which have no maturity. They're issued for perpetuity, and in that sense, they don't have a yield to maturity as any regular bond has.
Okay.
Or rather, they have something called a yield to call. Which essentially means that at the time of issuance, the issuer gives out a tentative date at which he will call back the bond and pay back the money. However, he retains the choice of calling back the bond on that day. He definitely retains that option with him.
Okay.
So perpetual bonds, especially those issued by public sector banks like say SBI or Bank of Baroda, they are issued by a lot of corporates and many private sector banks also. So perpetual bonds, especially those issued by government sector banks like public sector banks like SBI or Bank of Baroda, are very popular with certain investors, with some investors, because apart from the great deal of security which they offer, which is associated with these banks, they offer a slightly higher rate of return as compared to the bonds of the same issuers.
What kind of returns they generally offer?
So, for example, currently the perpetual bond issued by SBI, maturing in 2025, is offering a yield of anywhere between 7.4 to 7.5.
Okay.
That is the current yield on the perp.
And FD rates would be in the range of 5.5%.
5.5 to 6.5% anywhere. So these two instruments are issued by or offered by SBI are vastly different. They are not the same. The risk return parameters of both these instruments are very different. Because if you ask me, perpetual bonds are essentially tier 2 capital. They fall under the realm of quasi equity, which means that the issuer, which is SBI in this case, or any other issuer, is not obligated to pay the interest on the coupon paying date, right? So it is contingent upon the company being profitable on the date of coupon payment, and they might just choose to not pay the interest. Obviously, there have been very few cases where interest payment or the coupon payment has not happened on the due date, but that is definitely an option which is available with the issuer, and for that reason alone, that perpetual bonds offer higher rates of return as compared to the corporate bonds of the same issuer.
Okay.
Right.
So is this the only risk factor in perpetual bond, that these issuers may not call back the paper on their call date?
On the call date. So the risk factor that I mentioned before is that the coupon payment or the interest payment is contingent upon the company being profitable on the day of the at the time of the coupon payment. The issuer might just choose to not pay the coupon, that is the nature of the bond. It depends on whether the company is profitable or not. He might pay the coupon and he might not also. He retains that option. And
Okay.
because of that reason, perpetual bonds are significantly more risky as compared to the corporate bonds issued by the same issuer. The second, as you mentioned, is that the issuer might also choose to not call back the bond on the date of the callback.
Okay.
Right? He might choose to extend it. He might choose to defer it, indefinitely also. It is, as I said, it is perpetual in nature. There is nothing wrong with it. That is the nature of the bond. But just that the investor should not blindly chase the returns associated with the perpetual bond.
Okay.
He should be cognizant of the fact that there are risk factors associated. That's why there is a higher rate of return. And one should be prepared for the long haul. However, there is a silver lining also. So although they might be maturing in after a very long time, or they may not mature at all, they can still be traded on a daily basis on the market, just like any other bond, right? So a lot of people buy it off the secondary market and also sell it on the secondary market, just like any other bond. So one may choose to do that. So that is one good aspect associated with the perpetual bond also.
Okay. Aditya, thank you for your insights. So today we discussed corporate bonds, we discussed Bharat Bond ETF,
Yes.
we discussed debt mutual fund,
Yes.
which is a wide category. So we'll again cover this in detail in the next video, in
Yes.
coming videos.
Yes.
And we also discussed just perpetual bonds. Aditya, anything you want to say to the viewers?
So Sachin, no, that's it for now. However, we have some very interesting fixed income options, to discuss in the upcoming videos. Just to give you a glimpse, so we have an episode on a very long and elaborate episode on fixed income mutual funds,
Yes.
where we cover the entire spectrum of mutual fund offerings. Also, another dedicated episode on fixed income AIFs. So, alternate investment funds is a very promising, upcoming, and fast-growing segment of investments in India.
Great.
And there are dedicated fixed income alternate investment funds also, which we will discuss in a separate episode. So that's it for today, I guess. And thank you so much, viewers, and hope you like this video also. Thank you.